There aren't a lot of no-brainer home run calls when it comes to looking at the markets, but in December 2008, I came about as close as I could to one in the bond market. I came right out in Money and Markets and I said, long-term treasuries are in the biggest bubble of all time. The prices didn't make sense, the market action didn't make sense to me, and I basically said, if you haven't sold your long-term bonds, do it now. Since that point, bond prices have plunged and interest rates have gone up. You look at the yield on a 10-year Treasury, it was going for just over 2% at that time. Now we're knocking on the door of 4%. And that's very important, which is why I'm coming to you today. You are now looking at a perfect storm of factors for the bond market. Surging Treasury supply, which I've discussed before, rising sovereign risk, the risk that governments can't meet their obligations, and now on top of that, you have economic data that's getting better. We just had a job creation of 162,000 jobs in March. Some of that was inflated by the census, but still the underlying trends are better than we've seen. We have industrial production that's starting to perk up. We have pending home sales that rose more than 8%. You throw an improving economy on top of everything else that's hitting the bond market, and you've got nowhere to go but down in price and up in yield. Which again, to go back to that 4% level on 10-year treasuries, this is an extremely crucial technical level that we're flirting with here. If this goes, I would not be surprised in the least to see treasury yield shoot up 50 and then eventually 100 basis points from here. That may not sound like much, but you're talking about rates that went from 2% to almost 5%, more than doubling in the span of a year or so. This is very crucial. This is very important. Is the stock market prepared for higher interest rates? Is the housing market prepared for higher interest rates? More importantly, are you prepared for higher interest rates? If you own long-term bonds, whether they be government bonds, municipal bonds, or corporate bonds, you could get hammered by a rise in interest rates and a fall in bond prices. So please, if you haven't already done what I've been recommending for months and months, get rid of your long-term bonds. Stay in short-term debt, debt with maturities of less than 2 years, preferably less than 1 year if you can swing it. And then once the rates get done rising, the prices get done falling, then you lock in those juicy yields and you're sitting pretty. Thanks again.